Welcome to another episode of Millennial Investing Explained. Here's today's question. How about outside of the stock market? Where have you found behavioral investing having a big impact? How about real estate or cryptocurrencies? Does it take place in those markets as well?
Let me speak to both of those markets because I think they're good examples. I meet so many people. I travel a great deal. I meet lots of people. And when I tell them what I do, everyone, is like, what? Like a psychologist that studies the stock market? Like, that's not a real thing. But I meet these people and I get to talk to them and hear, the people I'm sitting next to on a plane give me their, candid insights into markets. And one of the things that I very, very commonly hear is I don't like to invest in the stock market, which a lot of these folks will refer to as being like Vegas. Oh, the stock market's just roulette. Like it's like Vegas, which is, of course it's not. But they'll say, I like to invest in, bricks and mortar. Like I like to invest in real estate and I invest in my home, which, I'm speaking to you from my home. I'm a homeowner. I'm not against that. But, a home has a number of interesting characteristics that make it a more comfortable investment than, say, stocks for a lot of people. Think about your home. Your home has historically been pretty illiquid, and you haven't known minute to minute what your home was worth. Right? You didn't drive home and, there's not a sign in your front yard that says, hey, your home is worth 2% less today than it was yesterday for you to panic and freak out. And so people like to invest in real estate because in a way it forces them to be good behavioral investors. It sort of ties their hand. You have to be a medium to long-term investor unless you just want to invoke some pretty significant churn fees where you know what you're doing flipping houses. It's been opaque. It's been illiquid. And oddly, those are things that have made it a really attractive investment from a behavioral standpoint, even though if you look at Robert Shiller's research on residential real estate has appreciated at about 2.5% a year in the US over the last 100 years. Like it's keeping up with inflation. It sucks. It's a terrible investment. But people think it's great because they don't have to watch it go up and down every day. They can't check the price on their iPhone and freak out about it. Now, interestingly, Zillow is kind of changing all that because, every month, I think it is, I get a thing from Zillow with my home and it says, this is what your home is worth now. And it'll swing pretty wildly. It'll swing 5 and 6 figures swings since the time I bought it. And so it'll be interesting as technology improves and things like Zillow come into play. Will people start to panic and freak out and make the same mistakes with their home that they have historically with stocks? Maybe. And then cryptocurrency is just an incredible example because in many respects, cryptocurrency is no different than currency. Currency, the only reason that you and I spend our days toiling away for little green pieces of paper is because we believe in it, right? This is backed by nothing more fundamental than our faith, our belief in this system of the little green paper getting us the stuff we want. So cryptocurrency, a lot of people poo-poo it, but cryptocurrency is no better or worse than regular currency in that respect. It's just newer and it's unproven. So, cryptocurrency isn't really backstopped by anything fundamental the way that a house is. Any asset you would choose has an element of behavioral psych to it.
Do you think that the run up to 20,000 was driven primarily by behavioral psychology in cryptocurrency markets and specifically with Bitcoin?
Yeah, I'm no expert here. I wouldn't begin to know how to put a value on cryptocurrency because, there's no dividends. I can't do a discounted cash flow analysis on it. I can't, it doesn't keep the rain off my head. But that's not me knocking cryptocurrency. It might turn out to be wonderful, but it shows you, the run up to 20,000 and then the precipitous drop since then. All of these things are investor psychology. And, it's probably too much on the upside and probably too much on the downside. But one thing that's true about human nature is we tend to project the recent past into the future indefinitely. Like this is one of the things that we do. So when Bitcoin was climbing from 5 to 10 to 15 to 20, people would look at that recent past and go, oh my gosh, Bitcoin's never coming down. And the same thing on the way down, people see it getting halved and people seeing dropping precipitously and they go, oh, this is all that's ever going to do. The truth is probably somewhere in the middle because trees don't grow to the sky, right? It's not going to go up forever. And so we have to be careful to account for mean reversion in markets, because we tend to think that whatever's happened in the recent past is going to keep happening forever. And markets have a way of proving that wrong.
That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.